for each recipient. In the meantime, many years of high inflation had reduced the real value of the original debt to a fraction. History is replete with examples of sovereigns that have reduced the real value of their debt by printing money too. Inflated away. Debt is ordinarily a fixed nominal amount. As long as debt is in the country's own currency. Sovereigns can reduce their real debt burden by inflating prices. Holders of that debt then find that its value is falling sharply in real terms. Even if the nominal debt remains in the books. Inflation may thus be a de facto tax on creditors. Public debt becomes a bigger problem for countries with debt in a foreign currency. A classic example is Argentina's US dollar debt. Which domestic inflation could not reduce. Greece experienced similar problems when its nominal GDP fell following the financial crisis. Greece and Argentina had to undergo painful adjustments to be able to manage debt that had become excessive, to the detriment of their citizens. Debt incurred by firms can effectively be restructured. At least for those that are organized as limited liability companies. In a bankruptcy, the firm's debts are settled by liquidating the company's assets. If there are insufficient assets in the bankruptcy, estate to satisfy the creditor's claim, the creditor must absorb the loss. Speedy and efficient liquidation of insolvent companies is crucial for the economy's overall ability to restructure. Innovate and grow. This is closely related to creditor protection. Creditors enjoy high standing in Norwegian legislation. High creditor protection. makes it relatively easy for creditors to demand liquidation when the conditions are met. As long as the legal system and administrators in bankruptcy function as intended, the creditors may realize their claims on the estate and resources are freed up for society. It is essential that resources, labor, skills and capital, that are tied up in an unprofitable business are freed up for new activities. This also provides adequate, if painful, adjustment in a crisis. The downturn is shortened, and the economy gets back on its feet faster. Household debt is harder to restructure. Norwegian households can settle debt by liquidating their assets. But this usually only takes place after the borrower dies. Before that, the rule is that debt follows you to your grave. Norway has a debt settlement act. Very few would voluntarily petition to enter into a debt settlement arrangement. While some of the debt may be forgiven, such an arrangement involves garnishment of wages, down to the minimum for necessities. Many of those who enter into such an arrangement in Norway struggle with debts incurred while self-employed. Recent years have seen a sharp rise in consumer debt. Defaulting on this sort of debt is much more common than defaulting on a residential mortgage. Default does not mean that lenders forfeit their money. If a borrower defaults on consumer debt, the creditor can have the debtor's wages garnished. Sale of assets may be necessary to avoid a debt settlement. Arrangement. This gives lenders strong protection, also those handsomely compensated for the risk by the high interest. Rates they charge on unsecured household loans. Creditor protection is intended to induce prudence among borrowers. Since they know that the debt will have to be repaid. Paradoxically, this may make it just a little too attractive to promote this kind of credit. Mortgage debt normally entails sound collateral for the lender. Nevertheless, in downturns when property prices fall sharply, such debt may be difficult to manage. If many people try to deleverage at the same time by selling their homes, prices and collateral values will fall. If collateral values fall sharply, it becomes difficult to restructure debt. What is the significance of the housing market? Argili tracks house prices. So despite the substantial rise in consumer debt in recent years, the big picture continues to be dominated. By mortgage debt. As we invest so heavily in housing, primarily using borrowed money, house prices are a key. Determinant of our net wealth. It is often said that people in Norway own their homes. Reality is slightly more. Nuanced. 23% of Norwegian households rent the home in which they live. However, it has long been a cross-party objective for people to be able to own their home if they wish. Chart 5, Strong House Price. Inflation. As we can see from the chart, inflation-adjusted house prices have fluctuated over the past 150 years. House prices reached a preliminary peak in 1899, the year before the housing market crash in Christiania, the name of Oslo at the time. Falling thereafter, especially during and after the two world wars. If you had Bought a home just before the Christiania crash, it would have taken more than 80 years for you to recoup your investment. And after the fall in house prices at the end of the 1980s, 12 years passed before prices returned. To 1987 levels. Following the banking crisis at the beginning of the 1990s. House prices took off and in real terms are now more than twice as high as before the housing bubble burst at the end of the 1980s. A home purchase. Has been for many years an exceptionally good investment. Thanks to rapid house price inflation. Many of us have accumulated considerable wealth, at least on paper. Chart 6, how much housing can an average wage buy? Stable. Inflation targeting is forward-looking and flexible so that it can contribute to high and stable. Output and employment and to counteracting the build-up of financial imbalances. Monetary policy. Cannot assume primary responsibility for financial stability. But as we are now in the process of raising the policy rate somewhat. This could also help curb debt growth. Will debt be reduced? Debt now still continues to rise, further measures may be necessary. John C. Williams, The New Normal for Growth. Remarks by Mr. John C. Williams. President and Chief Executive Officer of the Federal Reserve Bank of New York, at the Community Bankers Conference. Hosted by the Federal Reserve Bank of New York City, April 4, 2019. The Fed is tasked with two goals: low and stable inflation and maximum employment. From the perspective of monetary policy, things are going very well. and the economic fundamentals indicate that. Slower growth is far from a sign of doom and gloom. What we should expect. The economic fundamentals. The 3% growth of 2018 was boosted by a number of tailwinds. Strong global growth, fiscal stimulus. And accommodative financial conditions all helped drive GDP growth and a tight labor market. These tailwinds have calmed and in fact reversed in some cases. Three developments contribute to this view: a downturn in global growth, heightened geopolitical uncertainty, and the effects of tighter financial conditions. If you strip away these factors, you're left with the underlying drivers of potential growth, which are demographics and productivity growth. Both of these have slowed significantly. Baby boomers are retiring and fertility rates have come down. Which has significantly slowed labor force growth relative to past decades. Productivity growth has also fallen considerably. From the boom years of the late 1990s and early 2000s. I put the potential growth rate of the US economy at about 2%. Which is in line with the forecasts we're seeing for this year. Of course. A number of different scenarios could play out. Geopolitical uncertainty and other factors holding back growth may recede. And the US economy could resume the robust trajectory of last year. Or GDP growth could continue closer to trend. Which is my own forecast. Finally, there's always a chance that downside risks could knock GDP growth off. Course. But what the data's telling us is that this period of slow growth isn't an aberration, it's the new normal. we should expect for the foreseeable future. Monetary policy. So what does all this mean for interest rates? Sabine Lautenschlager, interview in Der Standard. Interview with Ms. Sabine Lautenschlager. Member of the Executive Board of the European Central Bank, in Der Standard. Conducted by Mr. Andras Sajidvari on March 27, 2019 and published on April 1, 2019. Asterisk asterisk asterisk. Can you enlighten us? Is the ECB stealing interest income from savers? Are savers being dispossessed? Many German economists and politicians are convinced of exactly that, leading them to harshly criticize the ECB. Leadership under Mario Draghi. I appreciate that people are concerned. It's true that putting money into a savings account these days will earn you very little interest. But it's also true to say that people can only save. If they have a job and earn enough money to put some savings aside. Our monetary policy has made an important contribution to boosting employment and wage growth. And people are not only savers, but also entrepreneurs and home buyers. Who benefit from low interest rates. So the question we need to ask ourselves is, if the ECB had not taken certain measures in the past, what state would the economy be in today? And how will you answer that? There was a high risk of deflation in the euro area. Deflation would have meant falling prices. With people therefore postponing their purchasing decisions in anticipation of prices falling even further. At the same time, firms would have reined in investment and there would have been job cuts. That is a vicious circle. So it was. Absolutely right to counteract this danger by lowering interest rates and to generally loosen monetary policy in order for us to bring inflation to a level below, but close to, 2%. The ECB has now bought government bonds. And other securities amounting to 2.6 trillion euros. Interest rates have been at zero for years. You are offering banks unlimited credit. As long as they can back it with appropriate collateral. The official motivation for taking all these measures was to bring the inflation rate up to just below 2%. That is the ECB's inflation target. But inflation is currently at 1.5% and the ECB has fallen short of 2% for years. So what is the point of it all? Again, we had to respond to the risk of deflation, and we have come nearer to our aim of maintaining an appropriate level of inflation over the medium term. Our actions have had an effect. Lending to households has been boosted just as much as lending to companies. So we have seen an overall rise in the propensity to invest. The negotiated wage agreements also show that our measures are having an impact. Wage growth in the euro area stands at more than 2%. And it is even slightly higher in Germany. That will push up prices. But it is slower than we had thought. Why?